Welcome to the channel. This is Rudy. Today we're going to talk about building our foundation for our portfolio. What's going to be the staple for our portfolio, what holds us up in good and bad times, something that you can dollar cost average into. Yeah, you might overpay sometimes, but sometimes you're going to underpay, and you're going to find a ballpark average that you're dollar cost averaging into over the course of 20 to 40 years. But first and foremost, I'm not a licensed financial advisor. Everything in this video contains merely my opinion and is for entertainment purposes only. So going through this Vanguard ETF list, you're going to see there's a lot of different ETFs, and this is only for Vanguard series at the moment. So I can understand why, for a new investor looking for an ETF to buy, why it would be a little overwhelming. It'd be hard to decipher which one you wanted to choose. This is why I'm making the video on it. When I was building my foundation, I initially started with just VT, the Total World Stock Market ETF. Now my goal was to recreate the world's economy in a sense, simply because I think 30-40 years down the road, the world's economy is going to be a better place. Why do I say that? Because there's new stuff invented all the time to help the world run more efficiently in a sense. And that's why I think it's important to find a broadly diversified index fund that has exposure to that international. So going into VT to start off, Total World Stock Market ETF. First and foremost, low expense ratio. Now, as mentioned in the first video, when talking about mutual funds are going to have higher expense ratios because they're actively managed accounts. The person running that mutual fund needs to get paid in some way, shape, or form. Where they get you? They get you on expense ratio. Now, this expense ratio is getting taken out of your return every single year, whether you like it or not. That is why we want this to be as low as possible. So 0.07, very manageable. Next, we'll look at, we're not going to dive too deep into this. Trying to keep this video around 5 minutes, 6 minutes or so. But number of stocks in this ETF, 9,400 different holdings. Now, I don't know how accurate that is. It changes all the time from my experience of looking at VT, but broadly diversified, 9,000 different holdings, a one-stop shop, and you're getting 9,000 different stocks. I like the idea of that. Now, weighted exposure, roughly 60% United States, 40% international. Now going to the VXUS, the second one that we're going to talk about today, the Total International Stock Market ETF. Expense ratio, very low, 0.07. Very good. Number of stocks, north of 7,800 holdings. Now, same thing. This varies from my experience. Now, this is a newer addition to me, so I haven't personally held this for too long, only a few months. But you'll understand why I added it to the foundation, why I think it's important to have this for recreating the world's economy. Reason being the weighted exposure. South of 8% United States, leaving 90 to 92% internationally. Now this is why matching the two ETFs together, in my point of view, is recreating the world's economy. Because VT, 60% US, VXUS, 8% US, VT, 40% international, VXUS, 90% international. And on top of that, 9,000 holdings in VT, 8,000 holdings in VXUS. So before we wrap this video up, we're going to do a slight comparison to the S&P, because I know a lot of people dollar cost average into the S&P. Me personally, the S&P didn't interest me. Now this is why. We're looking at VT versus the S&P. VT, 9,000 holdings. S&P, 500 large companies in the United States. Now, when I was building my foundation, I didn't like the idea of having all my money tied into the largest companies of the United States. What if there was a scenario when that was the only thing that was holding up the 500 large companies in the United States? What if that were to drastically underperform over the next couple of years? I don't know. I don't have a crystal ball. I can't tell the future. But 27.5% weighted into the top 10 compared to only 13.5% This 13.5% is a lot more enticing to me, especially when you have a cash balance as a top 10 holding. These are all reasonable weightings into a portfolio. This to me looks like a red flag when your top 10 holdings is weighting this much. I don't like the idea of that. So that is why I really liked VT, especially over the S&P. Now lastly, we'll do S&P versus VXUS. Same scenario. 8,000 holdings, 500 large companies in the United States. Now what's different, top 10 holdings, you're getting this exposure to these large international companies. Taiwan Semiconductors, Tencent, Alibaba, and then most importantly, a cash balance for their top holdings. And once again, I'll reiterate, 27.5% in your top 10 holdings, 11% in your top 10 holdings. Broadly diversified index fund. Now, matching VT and VXUS, I look at it as recreating the world economy because the world economy is going to be a better place in 30, 40 years. That's when I'm looking to retire. And I think I'm going to benefit greatly from dollar cost averaging into these two ETFs. I hope you guys liked the video, and I will see you on the next one.